House prices are climbing to right now over 8 times average earnings. But what if I told you there was a way to fix it? That in the past, house prices actually got to 12 times average earnings, but were brought back down to just 2 to 3 times earnings years later. In this video, we'll dive into nearly 2 centuries of data to uncover the real story behind house price affordability in the UK. And more importantly, what can be done to make homeownership attainable again. Whether you're a first-time buyer or a seasoned investor, this is one video you won't want to miss. And in case you don't know me, I'm Gale, and I've spent since 2012 building a UK-wide home buying company and nationwide estate agency that has dealt with just over 13,000 transactions, totaling about £3.3 billion of property. So I'm sort of motivated to understand this stuff. So let's get into it. 1845 to the present day. Currently, house prices are over 8 times average earnings, but despite how bad that seems, it has been worse. Back almost 150 years ago, in the year 1876, we saw house prices relative to income at about the same level as now. And if you go back even further back in time, the situation has been worse, with house prices as a multiple of average earnings reaching over 12 times back in 1845. To put that into perspective, currently average house prices are about £290,000 and average earnings are about £36,000. So that would be the equivalent of average house prices increasing from £290,000 to over £430,000, a 50% increase. So before you think house prices can't get worse, they can, and they have in the past. But importantly, look at how they went from being over 12 times earnings to just over 2 times earnings over a 70-year period, before taking just over 100 years to head back up to the current day house price level of 8 times earnings. So the history of our property market teaches us, it proves to us that it is possible to have a property market shift from average house prices hitting over 12 times average income back down to just 2 times average income. So how was this achieved? Well, there were 3 important drivers that led to this multi-decade downward trend of house prices relative to earnings. And they were: 1, more houses were built. It sounds obvious, but it was that simple. Between 1851 and 1911, there were an over doubling of housing stock in England, Wales and Scotland. It rose from 3.8 million properties to 8.9 million properties. Currently, there are 30 million dwellings in the UK, so that would be the equivalent of us getting to 70 million dwellings over the next 60 years. So building about 670,000 homes a year for 60 years straight. Now, I know that immediately sounds mad, but there is more complexity to that I'm going to run through in the last section of this video, because the population between 1851 to 1911 doubled over that 60 years, whereas our population hasn't even doubled in the last 130 years. In fact, it's increased about 70% over the last 130 years. I'll run through those calculations later, where I figure out exactly how many homes we need to build a year. The next major driver that dropped house prices from 12 times earnings to just over 2 times earnings was smaller houses were being built. Before 1850, the average plot size of a house was 913 square meters, but by 1851, this had dropped to 268 square meters. Today, the average plot size of a new build is 333 square meters. So I know we all feel like new builds are built smaller these days, but they have been smaller in the past. And finally, the third main driver that dropped house prices relative to inflation from 12 times to just over 2 times was higher incomes. Whilst average house prices fell 23% over the 60 years between 1845 and 1911, which seems like a big drop, but actually equates to just 0.4% drop in house prices a year on average. Earnings at the same time rose 90% over the same 60 years, an average wage growth of 1.1% a year, which is actually really, really low. It's below our modern target of 2% inflation. So in a way, we have to forget about nominal house prices or nominal average wages, because in reality, the average wage could be £1 million a year today. But if everything is 50 times more expensive, we're actually all worse off. Everything is the balance of average wages against the average cost of things, from houses to milk and eggs. But look, there is a lot that's happened between 1845 and 1911 we need to bear in mind when trying to work out how we apply these learnings to today's modern world. What's happened between now and then? Well, loads of stuff has happened, but let me go through the main events for context. We had the Great Famine in Ireland. This caused mass immigration from Ireland and put huge pressure on UK housing demand. Then we had the Industrial Revolution. This created rapid urbanisation, increasing the demand for housing in cities that just wasn't there, driving up property prices. And then we had the Long Depression, a global economic downturn that led to a slowdown in the housing market, with property values stagnating or falling in many areas. So you can see between 1845 to 1911 where house prices relative to income dropped from 12 times to just over 2 times average wages. The economy had its fair share of challenges like we do today. It experienced mass immigration, a similar situation we have now perhaps. An industrial revolution. Could AI bring that same change to industry today? A recession, something we've all experienced more recently, and back in the 07-08 financial crash. Now, of course, it's hard to judge those challenges to our challenges, but I offer all of this really as context to make the point that unexpected things always happen, and there is always a cyclical nature to these things. But over it all, they all still maintained a relatively stable decline in house prices relative to average wages over that entire time, over that entire 60 years. And there's no reason we can't do the same. Now, of course, ever since, we've had all of these key events that you can see here happen, which are all significant, many unexpected, but the way in which the property market has been managed has led to the situation we're in now. It's led to a steady increase of house prices relative to average income for decades, but of course, most recently, exploding from the 1990s onwards. So how do we apply this to today's solution? So let's run through some calculations. Here, I've displayed the population and number of homes over that 60-year period, so 1851 and 1911, to illustrate the increase in the amount of property built. I've also added the same figures for today, as well as my forecast for 2084, 60 years from now. A key metric in all this is the population against the volume of homes calculated. So you can see in 1851, on average, there were 4.7 people per property that existed. That dropped by 15% to 4 people per property in 1911, and that resulted in house prices dropping relative to earnings from 12 times to 2 times. Today, we can clearly see how we live has changed a lot. 150 years ago, it was normal to have multi-generational families living together, bigger families, whereas today, with 2.2 people per property, that's a 45% drop in average number of people occupying each property. It's resulting in a huge housing crisis. It's no wonder, in a way, things are reverting back to how they were back then, with more young adults living at home for longer. But if we imagine to reduce house prices relative to wages, we need to see another 15% drop in the number of people per property on average. So a drop from 2.2 people per property to 1.87 people per property, as I've put in the forecast. And if we assume the population is going to keep increasing by 600,000 people a year, mainly due to immigration at the moment, we will need to have an additional just over 25 million homes built over the next 60 years, equating to 418,000 new homes built over that 60 years to gradually get the property market back under control. Right now, Angela Rayner has set the aim for 370,000 homes to be built each year, which, to be fair, does seem in the right ballpark based on the rough calculations we've just gone through today. So, how do we fix the property market? We need to make sure we actually build an economy capable of building 370,000 new homes at least for decades. And we can't let our population grow beyond about 600,000 people a year. I know I've made some big assumptions in this video to simplify things, but what do you think of all this? What am I not considering? How am I looking at this wrong? What are other solutions that you might think could fix the property market? And finally, please like and subscribe if you want to see more of me. I'll see you in the next video up here.